This is your Swap Hunt Daily News for March 2nd, 2026. Bitcoin ETFs just snapped a 5-week outflow streak even as geopolitical tensions push fear to historic lows. Markets are bouncing today after a brutal stretch, but sentiment remains deep in extreme fear, one of the lowest readings ever recorded for this index. The total crypto market cap is recovering ground after heavy weekend selling tied to escalating Middle East tensions. Bitcoin is clawing back after dropping sharply on news of U.S. Iranian strikes, with oil markets still elevated and risk appetite fragile. The overall regime remains bearish despite the daily bounce, and institutional flows are still net negative over the past 4 months. Spot Bitcoin ETFs just ended a 5-week outflow streak, recording nearly $800 million in net inflows for the week. The rebound was driven by a sharp institutional return on Tuesday through Thursday, with more than $1 billion flowing in across those 3 sessions alone. Spot Ethereum ETFs also reversed course, posting their first weekly inflows after 6 consecutive weeks of withdrawals. Crypto analyst Nate Geraci noted that despite the extended Bitcoin drawdown, ETF holders held conviction throughout the outflow period, a sign that many institutional participants were sitting tight rather than exiting entirely. The weekly swing is significant, but context matters. Monthly net flow for Bitcoin ETFs remains negative, meaning the last 4 weeks still net out as a loss. Whether this marks the start of a sustained institutional comeback or a temporary bounce against a still bearish backdrop is the key question. The speed of the reversal, more than $1 billion in 3 days, does suggest that sideline capital was watching for a re-entry level rather than abandoning the thesis. Zooming out from last week's inflow reversal, the 4-month picture tells a sobering story. More than $9 billion exited Bitcoin and Ether ETFs since November, marking the largest quarterly outflow for crypto ETFs on record. That's not a blip, it's a sustained institutional pullback that has weighed on prices and market structure throughout the quarter. The record withdrawals reflect a broader shift in institutional positioning. Capital that once poured into spot Bitcoin and Ether ETFs during their launch euphoria has been quietly rotating out, with some flowing toward AI-linked equities, gold, and other macro plays. Analysts point to a combination of factors: exhausted demand, long-term holder distribution, and a lack of a new narrative strong enough to pull fresh money in. Regulatory uncertainty hasn't helped either. As spot ETF products mature past their initial honeymoon period, the test now is whether they can hold relevance as a durable institutional instrument rather than a one-cycle trade. The weekend brought a sharp geopolitical shock. U.S. and Israeli strikes against Iran triggered a cascade across global markets. Oil surged by 6%, Asian equities fell nearly 1.5%, and Bitcoin dropped hard as traditional markets reopened and began pricing in conflict risk. At the height of the selling, more than $100 million in leveraged Bitcoin long positions were liquidated within 15 minutes. The crypto market shed roughly $128 billion in market capitalization within an hour. Bitcoin briefly rebounded after reports confirmed Iran's supreme leader was killed in the strikes, climbing back towards 68,000 before correcting again, but the situation remains fluid. Analysts flagged ongoing risks: missiles hitting Dubai, potential Iranian retaliation across the Gulf, and the possibility of disruption to the Strait of Hormuz. Bitcoin has now fallen nearly 50% from its October 2024 peak and has failed to track gold's recent gains during the geopolitical escalation, which has frustrated investors who held the digital gold narrative. The Bitcoin Fear and Greed Index just touched a reading of 9, an extreme fear level reached only twice before in the asset's history. The first was during the extended 2018 to 2019 bear market. The second came during the FTX collapse in late 2022. Both episodes were eventually followed by long accumulation periods and then substantial recoveries. That historical context has given some analysts reason for cautious optimism, framing the current fear reading as a potential bottoming signal rather than a prelude to further collapse. The logic is straightforward: when sentiment hits these extremes, the marginal seller has largely already sold. What historically follows is an extended period of sideways accumulation, typically lasting months before upward momentum builds. The critical caveat is that historical parallels are patterns, not guarantees. The current macro environment, with active geopolitical conflict and elevated oil prices feeding into broader risk-off sentiment, introduces variables that prior bear markets didn't fully face. Whether this fear extreme marks the turning point or simply reflects early-stage capitulation remains an open question. Strategy: Michael Saylor's firm has logged its 101st Bitcoin purchase, adding 3,015 coins for approximately $204 million. The buy was executed at around $67,700 per coin, bringing total holdings to 720,737 Bitcoin. Strategy has now made more than 100 consecutive acquisitions without a single pause in the accumulation schedule, even as prices have pulled back sharply from all-time highs. The decision to buy below their reported cost basis is a deliberate one. Saylor has repeatedly framed each dip as a buying opportunity rather than a warning sign, and the company's financing mechanism, issuing equity and preferred stock to fund purchases, continues to operate. For institutional observers, the consistency is either the clearest possible expression of conviction or an increasingly concentrated risk that hasn't been stress-tested in a prolonged bear market. Either way, Strategy's position now represents the largest publicly disclosed Bitcoin treasury in the world, and Saylor shows no signs of changing his approach. Galaxy Digital's head of research, Alex Thorn, delivered a candid assessment in a recent interview. Wall Street's sentiment toward Bitcoin has flipped from enthusiasm to skepticism. Thorn cited a combination of exhausted demand, heavy selling by long-term holders, and an absence of a compelling new narrative as the primary drivers, not manipulation or any specific bearish catalyst. He pushed back firmly on claims that firms like Jane Street were suppressing Bitcoin's price, calling those theories, in his words, Twitter cope. Thorn argued that Bitcoin's market cap is simply too large and the market too free to be manipulated in the way critics suggest. The more revealing data point in his analysis was the narrative competition Bitcoin has lost ground to. Capital that might have gone into Bitcoin has instead chased AI-linked equities, semiconductor plays, energy stocks, quantum computing, and gold. Bitcoin has failed since September to behave like digital gold during this geopolitical spike, and that gap between the narrative and the actual trading behavior has damaged its pitch to institutional allocators. Thorn sees long-term holder distribution as natural maturation, not failure, but the sentiment damage is real and will take a new catalyst to reverse. That's your Swap Hunt Daily News for March 2nd, 2026. If you found this useful, hit subscribe on Swap Hunt HQ here on YouTube and follow Swap Hunt on X for real-time market alerts. See you tomorrow.